the Fed get more dovish over time. They kind of finally ease their hawkishness. But what we saw in this recent week was that the Treasury came in lighter than expected for how much deficits they're expecting to run over this next quarter or two. And we also saw the Fed push back a little bit on the dovish narrative. They kind of reaffirmed some degree of hawkishness. They kind of took March rate cuts off the table, and they kind of delayed any sort of dovish action outright. I'm in the view of either no recession or soft recession, and the way I describe that is kind of sector-specific recession, or the type of recession you generally see in emerging markets, which would feel quite different than a recession you get in typical developed. I think the description of the macroeconomy is that we've had one of the biggest divergences between fiscal policy and monetary policy in recent memory. And so the general tightness of monetary policy is higher than normal. And at the same time, the looseness of fiscal policy, meaning the size of the deficits.
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day. In recent times, the Federal Reserve has notably softened its hawkish stance, signaling a more dovish approach to monetary policy. This shift suggests a greater emphasis on stimulating economic growth and ensuring stability rather than prioritizing inflation control. Contrary to expectations, the Treasury's deficits for the upcoming quarter or two have turned out to be lighter than initially projected. This unexpected development has implications for fiscal planning and resource allocation, prompting a reassessment of budgetary strategies. Despite the dovish inclinations observed, the Federal Reserve has recently pushed back against the prevailing narrative of dovishness. This reaffirmation underscores the complexities within monetary policy decisions and highlights the balancing act between fostering growth and mitigating inflationary pressures. These developments reflect the nuanced interplay between monetary and fiscal policies, shaping the trajectory of economic performance and influencing market sentiments. As stakeholders navigate these dynamics, adaptability and informed decision-making remain paramount in navigating the evolving economic landscape.
Especially relative to the size of the economy, is larger than normal, especially outside of a recession. And so that gap is resulting in sectors performing like their divergence in performance almost couldn't be wider than it has been in history. So, for example, things that are not sensitive to interest rates, at least as much, like profitable tech companies or restaurants and travel, things like that, they're generally doing quite fine. Whereas when you look over at commercial real estate or unprofitable tech companies or things that in general are either highly reliant on issuing equity or highly reliant on kind of shorter moderate term debt, those are the industries that are really struggling, especially if they've also been impacted by changes, things like work from home. And so this everyone's kind of focused on the question of recession or no recession, whereas I'm generally finding that some sectors are already deep in recession, whereas other ones are booming. And so you have to kind of answer that question on a sector by sector basis because you have this bigger than normal gap. And so the FOMC meeting and also the Treasury announcements this week were informative.
In today's economic landscape, we find ourselves amidst a fascinating phenomenon known as sector-specific recession. At its core, this concept highlights a profound disparity between fiscal and monetary policies, a disjunction that stands as one of the most significant in recent memory. Picture this: while monetary policies remain stringent, fiscal policies adopt a notably lax stance. This incongruity creates a dynamic where the reins of monetary control are held firmly, while the floodgates of fiscal stimulus are left open. Such a scenario sets the stage for a peculiar economic divergence, wherein some sectors flourish while others flounder. Within this intricate tapestry, we witness the stark realities of economic imbalance. Industries once deemed stalwarts of stability now find themselves navigating turbulent waters, buffeted by the winds of fiscal austerity. Meanwhile, others ride the crest of fiscal largesse, buoyed by the currents of government spending. Understanding the nuances of sector-specific recession is paramount in navigating today's economic terrain. It underscores the importance of a nuanced approach to policymaking, one that recognizes the multifaceted nature of economic dynamics. For policymakers and economists alike, it serves as a clarion call to embrace a holistic perspective, one that transcends traditional paradigms and embraces the complexities of our ever-evolving economic reality.
They showed us a slight diversion from the trend we've seen over the past quarter. So, the past couple quarters, We've seen larger and larger fiscal deficits, a lot of bond issuance, especially a lot of short duration, like bill issuance, which is really good for liquidity. And we've also seen the Fed get more dovish over time. They kind of finally eased their hawkishness. But what we saw in this recent week was that the Treasury came in lighter than expected for how much deficit they're expecting to run over this next quarter or two. And we also saw the Fed push back a little bit on the dovish narrative. They kind of reaffirmed some degree of hawkishness. They kind of took March rate cuts off the table, and they kind of delayed any sort of dovish action outright. And so I think we're seeing a little bit of a consolidation with expectations going forward. But I think the overall structural view is still the same, which is that you have relatively tight monetary policy and you have relatively loose fiscal policy. I'm in the view of either no recession or soft recession, and the way I describe that is kind of sector specific recession, or the type of recession you generally see in emerging markets, which would feel quite different than a recession you get in typical developed markets. So when people think of recession now, they often think of either COVID or they think of the 2008 financial crisis. Whereas, for example, if you go back to the prior recession, you had the 2001 recession, which was obviously very bad for equities given how overvalued they were. But the actual recession itself was quite mild in terms of the unemployment rate, in terms of the GDP contraction, in terms of what other sectors did. It was not a very severe recession by most metrics. And I think that to the extent that we do get a recession, and I admit, in 12 months, there's a lot that can happen. But to the extent that we do get a recession, I would expect it to be more like that 2001 variety, where some of those unemployment statistics and some of those GDP contractions are maybe not as severe as people fear. But that, of course, can still have very big implications. I think one of the biggest concerns in the markets is that a lot of the bond proxy type of equities, so, kind of defensive, high quality equities, a lot of them have been bid up to very high valuations. Costco, for example, it's a great company, but the stock is trading at valuations that make it look like they're doing AI or something, right? And so you have that problem. Yeah, you have that problem where if you get even a middling economy, let alone a slightly recessionary economy, those valuations are just hard to justify at these very high levels. So I think it's very sector specific out there.
Recessions offer invaluable insights. Typically, individuals tend to recall major events like the COVID pandemic or the 2008 financial crisis when discussing recessions. These occurrences indeed left indelible marks on global economies, resonating across various sectors for years to come. However, it's essential to recognize that not all recessions mirror the intensity of these landmark events. Take, for instance, the comparatively milder recession of 2001. While it may not have sent shockwaves as profound as those felt in 2008 or during the COVID pandemic, it nonetheless made its presence known in economic data. One crucial aspect under scrutiny in contemporary markets is the trajectory of bond proxy equities, particularly defensive high-quality stocks. These stocks have seen their valuations soar to unprecedented heights. This surge in valuation has prompted concerns among market participants, as it signifies potential risks and vulnerabilities lurking within the financial landscape. Understanding these nuances allows investors and policymakers to navigate the current economic terrain with greater clarity and foresight. By drawing parallels to past recessions and scrutinizing market dynamics, stakeholders can better comprehend the intricacies at play and make informed decisions to safeguard against potential pitfalls.